Do you think that the 50-year mortgage is actually a good thing? Is it going to increase the borrower's ability to buy a home and to repay it? The answer is absolutely, fundamentally no. I'm sorry, Donald Trump, but increasing the length of money that borrowers can get ripped off for that mortgage is not going to help them. I say ripped off. I know that's really insensitive, but it's the 50-year mortgage is a terrible idea. Don't do it. Just under no circumstances should you do the 50-year mortgage. Welcome to Life in the Markets. My name is Tim Russell. Today is November 17th, 2025. Well, this week was another volatile week in the stock market. We had a lot of ups and a lot of downs, but overall, the markets from beginning to end held their own fairly well. Just looking here at the S&P 500, it was down 0.8%, so a little less than 1%. NASDAQ was down about 0.25%. The Russell 2000, again, these are smaller sized companies, was down more. It was down about 2.2%. Looking at gold, it was up a little better than 0.5%. Silver was up about 3.5%, while oil was down about 1/3%. Interesting. Do you remember we talked about Bitcoin very briefly last week and I said it was down 5%? Well, this week, the sell-off in Bitcoin continued. It was down another 10% this week. So that's certainly something that I find interesting. I certainly will want to watch how that plays out. Bonds were slightly down about 0.2%, while the 10-year Treasury ended up about 4.118%. That's as far as that's the interest rate on the 10-year Treasury. All right, let's get into the weeds of some things that came out. It's great that the government finally reopened. We always love to be able to have the government open, doing what they're paid to do and giving us the reports and the information that we have been waiting for. One of those announcements that we've been waiting for from the IRS, we should have gotten it a couple weeks ago, was the 2026 annual contribution limits for things like 401ks and IRAs and such. So they did finally release that information earlier this week, and we can have release it to you now. So for individuals who are contributing to a 401k plan, your contribution limit is now $24,500 a year. That's up from $23,500. So it's a $1,000 increase. For those who are 50 and above, get this, the annual contribution limit is actually $32,500. That's a substantial increase, about $8,000 of an increase that you're allowed to contribute for being over age 50. It's your catch-up contribution. Now, if you're tracking these things at home and you're thinking about, well, how much do I need to be deferring from my paycheck to max out my 401k each year? For those who are below 50 years old, we're looking at $942.30 per pay. That's assuming you're paid 26 times a year or every other week. For someone who is 50 and above, that number jumps to $1,250 per pay in order to get you maxed out for the contribution limit. All right, let's talk about IRAs. This is something that perhaps more people would be interested in. The IRA, that's traditional and Roth IRA contributions, also increased for next year. They're up about $500 from what you could do last year. Last year, you could do $7,000. This year, you could do $7,500 for those who are 49 years and lower. That equates to roughly $625 a month if you're making monthly contributions. So if you're regularly maxing out your Roth IRA, doing monthly contributions, you would want to increase in January, increase your IRA, your Roth IRA contribution to $625. The contribution limit for someone who is 50 years and older is actually an odd number. The catch-up has always been about $1,000 per year that you're able to do if you're over 50. This year, it's actually $1,100, which means that if you want to max out your Roth IRA and you're 50 and above, the contribution would be $8,600 a year or $716.66 a month. Again, make note of that, and you want to increase those contributions to be able to max out your Roth IRAs. You can find these numbers on our website, or you can reach out to your financial advisor and we can help you figure out what you need to do to max that out. Simple IRAs also got an increase. The simple, you're now able to contribute $17,000 or $21,000 if you're over 50 years old. And if you have a health savings account, the health savings account contribution limit is $4,400 for an individual or $8,570 if you are a family or contributing for your family. The next thing I want to talk about today is Donald Trump announced a new 50-year mortgage, and his stated purpose for that is we have a home affordability crisis here in America. Therefore, if we are able to lower the monthly cost of a mortgage for an individual, then clearly that's going to help make more people be able to afford a home. The problem with that is that math doesn't math. It actually, that's not how it works. So let me break this down for you. I'm going to compare 3 different time frames for loans so that we can get our head wrapped around what is actually going on here. So we'll look at the 15-year mortgage, the 30-year mortgage, and then compare it to a hypothetical 50-year mortgage, assuming that it gets through. And again, we have to make some assumptions about interest rates, and you'll see here that really makes a huge difference. So there are several things that you need to know first off. The first thing you need to know is that there's something called time value of money. The longer I have my money locked up, the more I'm going to charge you to hold on to my money because I have to take a risk that maybe you're not going to be able to be solvent for the entire period of time. There's a risk of 5 years is lower for you having solvency problems than if I go to 30 years. But imagine now if I extend it to 50 years, the amount of risk I'm taking that you might have a solvency crisis or a financial crisis increases dramatically. So the longer I have my money at risk, thinking me here as the bank, the more I'm going to charge you to borrow money from me. The time value of money, the longer the loan, the higher the interest rate. So we see this already. Today, the 15-year mortgage is roughly 5.49%. That means that if you borrow the money for 15 years, you're paying 5.5% back over the course of that loan. Now, if you double that time frame, your interest rate doesn't double, but it does increase. Instead of 5.5 or 5.49, it goes to 6.24 or 6.25%. You're taking longer to repay, the risk is higher, therefore the cost to you, the borrower, will be higher. So what do you think is going to happen if we extend another 20 years, tack another 20 years onto the back of that loan? Interest rates are likely to go up more substantially. So instead of 6.25%, I wouldn't be surprised if it's 7.25%, a full percent higher. The higher that interest rate goes, the bigger we have a problem with the affordability of that mortgage. Now, let's just look at the next period. When we deal with the actual monthly cost, and we look at let's right now only look at a hypothetical $300,000 mortgage. We're going to look at a 15-year, a 30-year, and a 50-year mortgage here for $300,000. And we're using the rates we just talked about, 5.5, 6.25, 7.25 interest rate. The mortgage, the monthly cost for the 15-year is $2,400 $450. Okay, that's a high cost, but it's a short repayment period. Now, if we double the time frame, that mortgage drops from $2,450 to $1,845. So that is a decrease of roughly that's $600 a month. That's obviously meaningful savings for a family trying to afford their payment. However, if we take a 50-year repayment schedule, same loan, the interest rate being now higher, 7.25%, that cost per month increases from $1,845 to $1,862. Instead of saving you money, it's actually costing you an extra roughly $20 a month. But the cost over the life of the loan becomes mind-bogglingly stupid. So the third thing let's talk about is, what does it actually cost you over the life of a loan to borrow a 15, a 30 versus a 50? A 15-year loan is going to cost you roughly $140,000 of interest over the course of those 15 years. If we look at the 30-year mortgage, instead of $140,000, get this, it goes up to $364,000 in interest payments over the life of that loan. And if we extend it out to 50 years, you're now paying back $817,000, and that's just the interest. That's on top of the principal that you will also have to pay back on that loan. So riddle me this. Do you think that the 50-year mortgage is actually a good thing? Is it going to increase the borrower's ability to buy a home and to repay it? The answer is absolutely, fundamentally no. I'm sorry, Donald Trump, but increasing the length of money that borrowers can get ripped off for that mortgage is not going to help them. I say ripped off. I know that's really insensitive, but the 50-year mortgage is a terrible idea. Don't do it. Just under no circumstances should you do the 50-year mortgage. What's a better option? The better option is if we were to focus on the real part of the crisis here, which is the building rate. How many new homes are we building per year? We have in this country new home formation. These are new families, new households that are being created at a much higher rate than we have new houses being constructed. So with that in mind, we're way under building for the amount of population that is growing. We are going to have an affordability crisis if we have regulations that prohibit and penalize people for building homes, if we value slugs over humans, and have environmental regulations that are about the protecting of the slugs rather than the protecting of the humans. I'm sorry, but that is also going to cause problems with our home affordability crisis. So reduce the regulations, allow builders to build. That in and of itself is the single best thing we can do to help manage the home affordability crisis here in America. And I agree, it is a crisis. It is less of a crisis than certain other places in the world, but that is nothing to be proud of. We still have a problem here. We have to deal with it with sensible solutions. The 50-year mortgage is not a sensible solution. One additional thing, I'll just say this in passing, that he announced the ability to make your mortgage portable. So if you have a 3.2% mortgage and you want to buy a new home, you can actually keep that same mortgage and take it with you to your new home, maybe get a smaller mortgage for if you have to borrow more money to get into the bigger home, you can do that as a second mortgage, but it allows you to keep that lower interest rate. That in and of itself is going to help the transaction rate here for home sales to increase. I think a lot of people are sitting on their homes because they can't afford to get rid of their very low interest rate to get a home that they actually need or would better meet their family and life situation. So all of that to say, make sure that the solution that we're offering actually matches the problem we're trying to solve. This 50-year mortgage absolutely doesn't do that. There's a lot more that we can talk about this week. There's a lot of other and interesting things that are going on in the world of finance and investing. But I think at this point, we're just going to leave it at that and say, thank you so much for listening to Life in the Markets podcast. Remember, the verse of the day is the borrower is slave to the lender. So again, don't take that loan out for 50 years. You're a slave to that lender for the next 50 years. Make your choices to be wiser and of a shorter duration. Thank you so much. Take care. Be safe in the markets.
The topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. All information herein is from sources believed reliable, but is not guaranteed for accuracy or completeness. The team assumes no liability for any errors, omissions, or actions taken based on this material. Information is as of the date stated and subject to change without notice. Securities and advisory services offered through Genius Wealth Management. Member FINRA and SIPC.